What we like to do is try and find things where downside's relatively limited, potential upside is greater, but we know that that's, there's a whole bunch of uncertainty out there. 2019, the one thing that I can tell you is that stuff will happen that no one has thought of yet. I'll start out by saying I'm a little bit critical of mass media in that they generally like to concentrate on the negatives in the world because that's what sells things. The way we go about investing, we let the data drive our results and our models. So we largely ignore what is in the press. 99% of the time, geopolitics and economics bear no effect on your investment related matters. 1% of the time they do. And at the moment, this is that period of time in which they potentially have an effect. So the things that we're concentrating on at the moment are the US-China trade negotiations. If that does not pan out well, that could lead to potentially a global recession. I think the probability of that is very, very low. The way that Trump goes about negotiations and has done so in the past is he is the type of person that negotiates person to person. The reason why I think that is actually advantageous, believe it or not, is that if you think of the Chinese psyche, that's the way in which Chinese generally do business. That's the way they generally do things. We heard Trump say that no deal will be done until I meet directly with President Xi. That's exactly what China want to hear because that's how they operate. So we're looking at China-US trade relations. We're quite confident that a deal will be struck. Other things that we're looking for, what we try to do is try and find assets where a lot of bad news is already factored into the price, but potential upside and good news is not. So I'll give a couple of examples. Emerging markets did really badly at the start of 2018 off the back of the US-China trade negotiations and rallying US dollars. Asia in particular took huge hit. So a lot of bad news is factored into those markets. If there is a really bad breakdown in trade negotiations between the US and China, those markets will not do well, but nowhere will do well. And arguably, because a lot of that bad news is already factored in, they should do less worse than other regions. However, if we have positive surprise to the upside, they should benefit even better than regions such as the US. Europe, people talk about the trade surplus that China has with the US. What not many people talk about is the fact that Europe actually has a larger trade surplus with the US. If China and the US reach some kind of middle ground on trade negotiations, Europe, because of the uncertainty surrounding Italy and Brexit, if you look at the price of European equities, they're relatively attractive. On a price to book basis, there's a number of different ways you can value things, but on a price to book basis, they are trading below their historical average. On a price to earnings basis, below historical average. On a number of other metrics, at about the historical average. So a lot of the bad news is relatively factored in. So if things go bad, they are likely to lose money, but probably lose a lot less than more expensive markets. However, if we have a positive surprise to the upside, such as a soft Brexit, which everybody now wants, if we have Italy in a position that they have to toe the line, at least for the next number of years, that's another positive surprise. China, late last year, to enact stimulus into the economy to offset the tariffs that were placed on Chinese exported goods, they enacted a number of things, including capital injections directly to the consumer, as well as reducing the reserve requirements amongst corporates. That stimulus has not fed through to the economy yet, probably won't happen until the middle of later this year. When that occurs, that could lead to another positive surprise to the upside, which will benefit both the Asian and emerging market regions as well as the European regions. given that both of those areas have priced in a lot of bad news, if we get good news stories, there's a huge amount of room for upside for those. If we get bad news, they are going to lose money. But I would argue that a lot of it's already factored in, so logically, they should lose less. If you then look at something like the US economy, it has grown at an exceptionally stellar rate compared to the rest of the world. It's essentially decoupled from the rest of the world. However, its markets have factored in that growth and then some, to the point that to justify current multiples, you would have to look at the fastest growing companies in the US and assume that every company in the US is going to grow at that pace, which is mathematically impossible, because if they did, then the corporate profitability of those businesses would far exceed the GDP of the entire country. That's impossible. It's mathematically impossible. And so therefore, the potential upside on things such as the US in a good news scenario is relatively limited, but the downside for bad news is quite large. So they're the types of things that we are looking at in regards to the world at the moment.